Legendary footballer Pele died at the age of 82 after a long battle with cancer, marking the end of an era. The Brazilian is the only player to have won the World Cup 3 times. The Brazilian government has declared 3 days of national mourning in his memory. I mean, you're with us here on a fresh new edition of Bazaar Morning Call. I'm Prashant, with me, my colleague Sonia and Mangalam. End of the year and end of a glorious chapter as well, right? I mean, in football history, we talk about who is the greatest of all time, but I think about this, there will be absolutely no doubt, no argument that the greatest of all times, GOATs are all compared to, what Pele did and what he achieved.
And of course, he lived a glorious life, right?
Yeah.
I mean, he rose from pretty much barefoot poverty,
Yeah.
and he rose to become the greatest athletes of our time. So, remarkable life and a life well lived.
I mean, he was beyond football, right? I mean, he was football, but
Exactly.
I think he was an icon just beyond football.
That's the beauty of, legends. They go beyond their sport, their vocation itself. I mean, not only did he make us love the game and him, obviously, he made us fall in love with the country, Brazil. Most of Indians, if you ask them who do they support in football, it will be Brazil. And Pele has one of the lion's share in terms of the credit that he needs to be taken. He needs to be given for us falling in love with football and Brazil.
Oh, absolutely. Just uplifting character. And as Sonia said, a life well-lived. And, so that's a somber piece of news we are starting with. And pay our respects to the great man.
Make a recommendation here, while you would be watching a lot of Pele football videos, etc. on YouTube and all the social media, there's a wonderful movie on his life which has been made. It's called Pele itself. Go ahead and watch it. I mean, Sonia spoke about him, coming off abject poverty and barefoot poverty, etc. There is a beautiful scene in that where one of his friends actually dies in a drain. It's heart-wrenching, gut-wrenching, but it's a beautiful movie to watch.
All right, that's a recommendation done. Mangalam, thanks for that. Well, let's kick it off then in terms of how things are looking as we focus and refocus back on the markets, right? I mean, we're trading. It may be the last trading session of 2022, but I have to say this. I mean, it's been uncharacteristically, lively, the markets. Volumes may have been dull, and you can complain about that, but price action has been lively. Now, strong pullback is what we've seen overnight in U.S. equities. You've got the S&P, which is up strongly. You've got the NASDAQ, which is up strongly. And what is this on the back of? It's on the back of weekly jobless claims, both initial and continuing claims, which came in line with expectations, maybe a little softer than expectations. Markets coming off kind of depressed levels, volumes are low, pointing to this data point and saying, well, the economy and labor market particularly, right? I mean, the number one problem for the Fed has been the fact that labor market still is very, very strong, even as other parts and other indicators are starting to slow down. Skeptics would still argue that these are weekly numbers, right? I mean, so in a week, anything can happen. So should you rely so much on it? But for what it's worth, last night we saw a reaction to this. Yields were lower. The 10-year was down 6 basis points. Dollar, that's under the 104 levels, the dollar index, that is. On the Nifty, we find ourselves, in the Indian context, we find ourselves in a pretty interesting juncture. So the Nifty retested the trend line from the June lows and actually closed above it. Actually, we'll put out a chart at the end of it which kind of explains this. So 3 numbers to watch. The trend line level now is 18,230. I mean, where today, because it's a rising trend line, so today as compared to yesterday is a little higher. So 18,230 is point number 1. The next is the 50-day moving average, which is a little higher than that, 18,250. So that's a 50-day. And then you basically have the 50% retracement of the entire fall from the all-time high of 18,887, which was made on the 1st of December this year, to the low on Monday, that is the 26th of December, this Monday. The 50% Fibonacci retracement is 18,330. So 3 kind of levels on the upside to watch. On the trend line, 18,230, then you've got the 18,249 level, and then you've got the 18,330 level. These are all near-term kind of indicators, and the market has been trading beautifully, within this kind of framework, retracements and moving averages. Bank Nifty is looking much stronger. As of yesterday, it is already closed above its 20-day moving average and the 61.8% retracement of the entire fall. I mean, so when an index does this, you basically are, the bearish signs are over, at least for the Bank Nifty, I would say, and things should look up. Basically back from where the market fell is what I would say. Now to the charts, which I think beautifully explain the story. The first one is that trend line I was talking about, all the way from the lows of June. 15,183 was the low on the 17th of June. There's a touch point on the 30th of September. And then you look at what happened. There was a breakdown below this 5 or 6 sessions back. As of yesterday, I don't know if you can kind of see that, but we closed above this level yesterday, above that trend line. So, the fact that the market is above it does give confidence, although bulls would want that level to hold. The second one is that retracement I was talking about. I don't know if it's very visible, but the one to watch, the one you want to watch is that the horizontal line in between. It's a retracement, as I said, from the all-time high to the low that we saw on Monday. And the 50% retracement is the middle horizontal line. And that number is 18,330, which is the next kind of resistance to watch out for. In between where the market closed and that 50% retracement, as I said, is the 50-day moving average, which is very, very close by 40, 50 points away from here. So just chartically speaking, I mean, as they say, picture is worth 1,000 words. And it does do the job of kind of reinforcing some of these levels. Sonia, hi.
Hi, morning. And, since it's the last day of the year, we must reflect on the year gone by, right? India has had a big degree of outperformance compared to its global peers. And not just the headline Nifty index, which is up about 5% at a time when most global indices are down anywhere between 10 to about 20-odd%. Not just the US markets, but, Asian markets like Hong Kong are down 15%. Nikkei is down 9%. But if you look beneath the headline Nifty index as well, it's been huge outperformance. I haven't put the data here, but the Nifty Bank is up over 20%. The Nifty Metal Index is up about 21-odd%. So the big question that we're asking is, will this outperformance from the Indian markets continue? Now, purely for today, of course, the Nifty has been consolidating within this band. It's a very narrow range. Perhaps the street is waiting for more cues as we head into the new year. The range is between 17,800 to 18,200. And Prashant spoke about the levels. The most important one for me is the 50-day moving average of 18,249. However, the flows are on the muted side. Once again, DI has bought just about 500 crores, but FIIs have been selling consistently. In fact, FIIs have sold now for 5 straight days, and about 3,500 crores has been pulled out of the cash markets from the foreign community in the last 5 days alone. And hence, there's a lid on the market's gains in the very near term. The next big trigger, of course, is 2 things. One is the quarterly earnings that come out from the first week of January. You have the auto sales as well on the 1st of Jan. And this morning, global cues are strong. The Dow ended almost 350 points higher, and the SGX Nifty is also indicating a start well in the green. So 2 big questions we're asking. 1, will the outperformance of India continue, which in all likelihood it could? And 2, is the worst over in terms of the sell-off, which I guess it is, given the kind of, levels that we're looking at. But what else are you tracking?
Well, it's good to look back on the last day of the year, but also important to look ahead on the last day of the year. So I'm looking at the January series, because yesterday was the end of the December series, and now in terms of F&O, we've already entered 2023. So to all the F&O traders, wish you a very, very happy new year already. Jan series usually hasn't seen big moves on either side, because if you just take a look at, the average moves in the last 5 or 6 January series, you would see that the moves are not any more than 0.5% to at best 1% here or there. And that's because volumes start to build up only in the second half of the January month. December saw a decline of almost 293 odd points. This after a rally of 1,700 points in the preceding 2 series. I mean, if you just take a look at October, 900 points on the Nifty in that series. November, we had around another 750 odd points. So some gains were given back on December in the December series. What's positive is that the rollovers or the conviction of the players is still the same. The 3-month average has been 79% for the Nifty rollovers. Into January, it has been 79% itself. The Nifty starts relatively on an even footing with 1.05 crore shares in open interest. But what's most interesting and it would keep the bulls excited is the fact that FIIs are starting the January series with just 57% long positions. That means there are shorts in the system, and they would support the market were they do not get any follow through on the downside. We started December series with the FIIs being long 77%. So most traders were on one side of the game itself, and as a result of which we saw the weakness that we saw in December. November and October, we had some shorts in the system and we did see big moves out there. But what are the important triggers for the Jan series? Sonia, you alluded to the third quarter results. I'll be looking at the management commentary as well, how the festive season panned out, how things are looking thereafter. Pre-budget expectations, the chatter starts somewhere in the second half of January. So to that, the markets also keep moving. The second half of December was also volatile because of COVID-related issues. So we'll keep a small eye on that one as well. And we're still not out of the woods when it comes to global central bank action and commentary coming in from there. So we'll watch out for the macro data too. So with that, we can say hello, January 2023.
Okay, well, say goodbye to 2022, right? Before we start the show, let's tell you what's lined up in the first half hour of the show. We'll get you updates from the markets across the globe, and Abhilash Narayanan of Standard Chartered Bank will be with us to discuss the global trade setup. Later, our research team will bring you the top stocks to watch at around 8:30 a.m. We'll do a fundamental stock analysis with Anand Tandon. Post that, you have momentumizers that will follow to decode the stock rally that we've seen. All right, so first up, let's get you some opinion coming through. On the equities front, we have Wendy Liu of JP Morgan, who reiterates China as their key overweight market in MSCI Asia ex-Japan, with a preference for internet, consumption, energy and industrials. She says India and ASEAN could be among the funding sources. Adds that over the past 2 months, the days of China reopening news have seen the weakest performance in Indonesia and India. She says market sectors with large global growth exposures may also see outflows in favor of China growth exposures in early 2023. So banking on China in a big way.
Well, let's get you some money market views. Bhaskar Panda of HDFC Bank says, as we approach the end of the year and markets remain illiquid against expectations of US Fed not pushing interest rate button as aggressively as it had done recently and the dollar index shedding weight, we could expect Asia ex-Japan to do better, especially after China's change in COVID policy. He says oil prices remain stable but trade persistently above the $80 per barrel mark. Given this background, he expects the dollar-INR pair to trade in a range between 82.65 to 82.85 for the day.
And on the bonds, Bhaskar Panda says that Indian bond yields have been steady and range-bound. He expects the same trend to continue today as well and expects the 10-year benchmark bond yield to trade in a range of 7.3 to 7.35% for the day.
All right, and on the last day of the year as well, we managed to eke out a lot of stocks to track today. We'll get you all of them in just a bit in our special top 10 segment. But for that, just give you a pre-cap of what we're watching out for. Eicher Motors, Craftsman Automation, Reliance Industries, Cipla, Supreme Petrochem, SBI Card, Punjab and Sindh Bank, City Union Bank, as well as Satin Credit Care on our radar on the back of positive news. And DLF is the only one which is likely to open in the red.
Okay, all right. Abhilash Narayan is now joining us, Senior Investment Strategist, Group Wealth Management at Standard Chartered Bank, Singapore. Abhilash, great to have you with us here. Thank you very much. Obviously last night you did not party, Abhilash. I hope, I don't know what
Clearly
your plans.
not.
Or maybe you did. We'll find out.
Don't feel too bad, Abhilash. We're all with you. All of us are here bright and early this morning. Whether the viewers are there or not, we don't know.
If the replies come a little slow and you slur your speech a little bit, I mean, we'll know. We'll understand. Abhilash, how are things looking as we wrap this year up? It's the last data point, I guess, but it's, weekly the claims number. Would you put a lot of weight to it? Because we have the numbers which came slightly below expectations, the rally last night, the drop in yields is being attributed to that. But weekly data can be pretty volatile, isn't it? Your sense?
Absolutely. And I mean, I wouldn't put too much weight into it because of one, it's a weekly data. And secondly, at this time of the year, the liquidity in the markets is fairly muted. So, the moves can be a bit exaggerated. Now, clearly, if you think about US jobs market data, any bad news is being treated as good news by the markets because at the margin, what that means is that it reduces the probability of Fed continuing to tighten the monetary policy at an accelerated pace. So a weakness in labor markets is viewed positively. I think just one thing that stood out to me from yesterday's data release is not only did weekly claims increase, but if you look at the continuing claims, which means that people who have applied for jobless benefits previously and are still claiming them, that rose to 1.7 million, which is the highest number that we have seen since February of this year. And that just goes to show that, for people who are out of the job market, getting into the job market, finding new jobs is not as easy as, what it seemed a few months back.
Okay. Abhilash, good morning once again. We just had a comment coming in a while back about how the outperformance in China over markets like India is something that could lead a lot of flows into China in 2023. Would you reckon that could be the case? I mean, will money move out of India and into China? or will there be outsized flows across the board?
Morning, Sonia. Well, clearly, I mean, the policy shift that we have seen in China over the past month has been much faster than what most of us were expecting. The pace of reopening was just unexpected, and that clearly has acted as a catalyst for Chinese equities. But we've seen Chinese equities rally around 20% or more than 20% since the October lows. So we think in the next 1 to 3 months there could be a bit of consolidation. So in the near term, the risk of outflows is sort of muted. But if I think about the whole of 2023, we think that, yes, there is a risk of reallocation of flows, more towards China for the year. But overall, we think that emerging markets should get net inflows from US and European investors. And that's simply because we expect, we are assigning a 75% probability of recession in US and Europe next year. And Asia is clearly a bright spot. I mean, India is expected to grow close to 7%. For China, we have a 4.5% growth forecast. So in an environment where there is recession concern in US, Asia and India, India and China are likely to attract capital flows. So net, we think that FDI flows should be positive for Indian equities.
Right. While flows would be positive and everyone's looking at India to outperform in the next year as well, after a great outperformance that we saw in 2022, Abhilash, at what point do valuations start to become a concern for India?
Well, we think that valuations are kind of stretched. So recently we downgraded Indian equities from overweight to neutral within the Asian context. And, while if you think about the underlying economic growth, that remains fairly robust. If you look at earnings expectations, we expect 15% earnings growth for FY23 and close to 18% earnings growth for FY24. So earnings growth are quite solid as well. But on a relative basis, Indian equities are quite expensive. And, heading into 2023, we have turned underweight on equities globally. So we think that any market which is trading at elevated valuations could come come under some pressure. So net, we still think that Indian equities should outperform global equities, so US and European equities, but the absolute returns may be muted going forward, and that's why we have turned neutral on Indian bonds versus Indian equities.
Okay, neutral on Indian bonds versus Indian equities. That's interesting. So if you're saying that, there is, of course, strong earnings growth and, the pace of reopening in China has been pretty good. Policy shift in China has been faster. Do you think that for the rest of the year, does it top your market A, your market list, that is preference list? And B, what is the strategy now from an Indian investor standpoint?
Well, so we are overweight on Asia-Japan bonds, Asia-Japan equities, and within that we are neutral on India. So implicitly, we are somewhat positive on Indian equities compared to the global context. But within Indian markets, we do have a preference for large cap equities, and from a sectoral perspective, we like financials as well as industrial sector, because we think that those are the sectors where we could see a really solid earnings growth come through.
All right, we'll leave it there, Abhilash. Appreciate you joining in, and Happy New Year from all of us here. Thanks very much.
Wish you and everyone a Happy New Year as well. Bye-bye.
Thanks indeed. Well, we'll take our first quick commercial break here. So that's a global view coming through. But on the other side, our top stocks to watch with our research team, as always, coming up in just a bit.
Welcome back. You're watching us here on Bazaar Morning Call. Let's tell you what stocks would be in focus today. Our research team, as always, is with us, joining in with CNBC-TV18's top 10 list of stocks to watch out for. Just look at all of them. We have them bright and early. Some of them reluctant because it's the last day of the year. But Sonia, we'll start with you. Take the lead. Eicher Motors and Craftsman Auto.
By the way, none of them are there. You said look at all of them. It's only me sitting here next to you. No, I'm just kidding. I mean, they're all, of course, going to join in. But first up, you have Eicher Motors that we're looking at. The company has decided to invest in a Spanish electric vehicle firm. It's called Stark Future, and they've bought 10.3% stake. They're going to invest $53.2 million for this stake in the first tranche, and the cost of the acquisition is about €903 per share. This, of course, is due to rising demand of electric vehicles. Now, this company, Stark Future, recently launched the motorbike Varg. And this is the EV motorbike, and that has garnered very good response. It's seen over 17,300 bookings in the last 11 months. across 3 major markets, USA, Western Europe and Australia. So with this acquisition or with this stake buy, Eicher Motors will get access to a lot of these markets as well. Now, what Eicher and Stark will do is together develop and research electric motorcycles. They'll do the technology, technology sharing, technical licensing and manufacturing. We only know about the first tranche of investment, which is about 50 million euros. Waiting more details from the management. But I'm going with green purely because, this is a step forward in terms of technology collaboration, technology sharing, and getting access to a lot of global EV markets as well.
Yeah, and when I said look at all of them, I also meant myself because I am watching out for both Reliance as well as Lotus Chocolate Company. Now, Lotus Chocolate Company is a BSE listed company which we don't talk about very often, but the news that came in yesterday evening was that Reliance's retail arm has acquired 51% stake in Lotus Chocolate from the promoters at 113 rupees per share. 51% has been acquired for 74 crore rupees from the promoters. They've also there has been a mandatory open offer. They've made it at a price of 115.5. The additional 26%, the open offer for that. The deal enables Reliance to basically enter the packaged confectionery segment. We've been talking about, Reliance's ambition to be an FMCG company as well. So this is another step in that direction. About Lotus Chocolate itself, the current market price about 117 odd rupees, 52-week high at 198. The market cap of the company, 150 crores. The FY22 revenues that they had were around 87 crores, margins at 7.5 odd % with a gross block of 23 odd crores. So these numbers are important to know, but the essential part is that with Reliance's ownership of this company and them sweating their assets a lot more, the chances for their business improvement are a lot more, which is why despite the price being at 113 rupees at which they acquired from the promoters and the open offer price being at a discount from yesterday's close, I go with green on Lotus because the parentage changes and perhaps the potential of the business too.
All right, Mangalam, thanks very much for that. So that's an interesting news item. Well, more stocks with news flow. Sonal is here with that. Sonal, hi, morning.
Good morning, Prashant. Well, let me start with Cipla. That stock is in focus because Cipla EU has invested 15 million euros in a company called Ethris, initiating a strategic collaboration here. Ethris is a company which is a global leader in delivering mRNAs directly to the respiratory system. So it has that respiratory portfolio in place, which Cipla plans to get into as well. Supreme Petro, which is in focus because the company has completed the EPS production facility revamp program or commissioning trial, so to say. EPS here is expandable polystyrene, and the production capacity will now increase to 33,000 tons per annum from current 24,000 tons per annum. DLF will be in focus because remember there were reports suggesting that they have received a demand notice. The company said yes, it is dated 23rd December, but they received it on 29 December from the Noida authority. The total demand is around 234 crore rupees. They will be contesting this demand and will take appropriate legal action, and post that there will be some outcome on this one.
All right, thanks a lot for that. Well, Surbhi is also with us this morning to talk about more stocks in the news. Surbhi, over to you. What are you looking at today?
Hi, so I'm looking at Punjab and Sind Bank and SBI cards because Punjab and Sind Bank has partnered with SBI cards to issue co-brand credit cards. Both the partners have rolled out 3 card variants: the PSB SBI card Elite, the Prime, and the SBI Save card. The next is City Union Bank, where the bank has opened 19 branches and the total branch network is now at 753 branches. And lastly, Saturn Credit Care, where they have received the second tranche of 25 crores from Florentry Ventures. The total investment by Florentry now stands at 50 crores. They have committed 100 crores in the form of convertible warrants, and the balance amount is to be paid by July 2023.
All right, thanks a lot for that. Well, here's a quick recap in case you missed out on any of the stocks. Stocks with positive news flow: there's Eicher Motors, Craftsman Auto, Lotus Chocolate Company, Cipla, Supreme Petrochem, SBI Card, Punjab and Sind Bank, City Union Bank and Saturn Credit Care, while stocks with negative news flow is DLF. Well, let's move on now. Manisha Gupta is joining in for a roundup of all the action in the commodity market, or the lack of action, I'd say. Manisha, good morning. Over to you.
Well, lack of action it is, because participation and volumes are just going down every day. Last working day of the year, and we are looking at weak volumes. But even with that, there's a lot of information still coming in. Take a look at the crude oil prices. There is a decline in prices on uncertain demand outlook, even as China is reopening, and we did see that support come into markets. But now more countries are considering restrictions on Chinese travelers. We already have seen that come in from US, India, Taiwan, Japan, UK is considering it. So that is what is is bothering all the industrial commodities. Apart from that, there also is a rise in U.S. crude inventories, where you have seen the U.S. imports climb, but the exports have seen a decline. Also, with the Keystone pipeline now fully operational, that premium seems to be going off the prices as well. So while the crude prices are down, the natural gas clearly seems to be breaking down, trading at a 9-month lows right now, and we are trading below $5 per MMBTU. There is lower heating demand forecast for early part of January. Also, the Freeport, Texas will restart its operations in Jan as well. So there's a lot to look forward to as soon as Jan begins. For the next 2-3 days, the expectation is that lower volumes will lead to exaggerated moves.
All right. All right, Manisha, thanks very much for that. So that's commodities as we kick off another day. We'll take another quick commercial break. Anand Tandon will be with us. He's our market guest for some fundamental stock talk. What is the trend at restaurants, bars, discretionary spending, all of that? We have A.D. Singh, promoter and managing director at Olive Bar and Kitchen, Gauri Devidayal, co-founder at Food Matters Group, joining in for that very 31st-like discussion, 31st of December-like discussion as we wrap this up. Stay tuned, coming up.
Welcome back. It's the last trading day of the year, and Happy New Year to all of you in advance. Market expert Anand Tandon joins in now to reflect upon the year gone by and tell us how he's approaching the new one. Anand, good morning and greetings of the season to you. It's been, we were just reflecting upon how India has seen a huge outperformance, and not just the headline index, but if you look at certain pockets, the Nifty Metal Index, the Nifty Bank, all up over 20% in the year gone by. What do you see as the big trend in 2023?
Well, Sonia, first of all, season's greetings to you and all your viewers, and Happy New Year. The market has definitely outperformed, and the outperformance has been stark, both in terms of actually even the corporate performance as well as the markets, relative as well as at absolute terms. The next year, obviously, will be a little more challenging. I mean, the number of headwinds that you are aware of already and a lot of people have commented on continues. And I think the biggest challenge that we will continue to see will remain the interest rates. I think the fact that the US may pause in the second quarter or thereabouts is something that is being already assumed by the market, and anything that happens which extends the time frame is going to be a bit of a shock. More importantly, I think the thing is that the market's already assumed that not only will it pause, it will start to have an immediate cut. And that, I think, is where the disconnect is. Because I don't see a cut happening anytime, very quickly, immediately after that, because I think you will continue to find that you need to reinforce the fact that the Fed is willing to take action. And based on that, I think, the challenge for equity is that with yields in debt becoming fairly attractive, overall, it is going to be a lot less attractive to be investing in equities in relative terms. And as a consequence, you may actually find that some amount of money gets shifted into debt, which is perhaps at this stage an under-owned asset class, as it were, within India. From a market perspective, I'm not taking into account fixed deposits, etc. People who don't invest. But among those who invest, I think most people have increased their stake fairly significantly in equities.
All right, Anand, morning. So just a quick word on some of the sort of movers that we saw yesterday. You got names like Nykaa, which moved up sharply. These are relatively newer listings, right? Nykaa not so much, but it's a year and a half old. There's Bikaji, which went up quite sharply. I think Inox Green was up some 9-10%. Any thoughts? Do you track any of these?
Well, Prashant, I think, today and yesterday's moves are more to do with the fact that we are ending the quarter. So I wouldn't read too much into that. But if you look at it thematically, certainly the only bet that one is taking is in the domestic side. Exports are likely to not do as much as expected. And therefore, most portfolios are now structured towards the domestic side, with clearly banking being the first. But now increasingly, the assumption is that, rural India will do better than, at least for this year for sure. How much better is a matter of conjecture. But, the sowing season has been fairly decent. Incomes are somewhat going up finally in the rural markets. And therefore, things like, FMCG, etc., FMCG or even any other consumer discretionary aimed at the rural side, two-wheelers, for example, would actually do reasonably well. So I guess the portfolios will shift accordingly.
So your case is that this year perhaps could be that of rural recovery. Anand, what are the other themes that you're watching out for? The last year, we did see a lot of the value themes do extremely well. PSU banks, the valuation differential between private banks and PSU banks. We did see a lot of the indigenization themes do extremely well. So defense was one of them. What do you think could be the themes of 2023?
Well, I think when you call it value, it is value only in the sense that you are getting growth now. So the assumption is that, the balance sheets of public sector banks have got cleaned up, and therefore you will see growth. So I would argue that it's not really value investing that you saw. You just saw a change in the sectors that you are going to see growth in. So defense, for example, for the longest time has held out promise. But last year you actually had order books coming through, and the government actually is putting in a lot of money there, which then increases the visibility of growth, and therefore the stocks have done exceedingly well. So as I said, I think if you look at where the growth is likely to be, I think from the sectors that have done well, banking I think will continue for at least another couple of quarters, especially corporate facing banks. Defense more or less looks like it's actually peaked out quite a bit, because from here the incremental order flow will only make the pipeline better. It's not going to change earnings anytime in the next 2-3 years. If you're looking at FMCG, as I said, you'll probably see a slight uptick there. If you're looking at, for example, two-wheelers and tractors, perhaps there is an expectation that volume growth will come back there. So essentially, those are the kind of sectors that one is looking to position in.
Okay, all right. Well, Anand, stay on. It is the end of the year, so we decided to have some fun with it, right? As we bid adieu to 2022 and get set to ring in the new year, the first after 2 COVID-hit years, we look at how the December festive season has looked so far for restaurants and bars and what's in store for the 31st. A.D. Singh, promoter and managing director at Olive Bar and Kitchen, and Gauri Devi Dayal, the co-founder at Food Matters Group, joins us now to discuss that. Ladies and gentlemen, thank you so much for joining us on the show. Happy New Year to both of you in advance. Mr. Singh, I want to start with you because, it has really been, it's like revenge partying going on, especially in some of the metros, right? Everything is booked out, hotels, restaurants, flights, you name it. But is this just the pent-up demand of 2 years? And what do you see as the big trends of the new year?
There are 2 trends this year that surprised us. One is that, it was financially very difficult for all of us. And yet, I think what happened is that people decided not to focus on a future that was looking very troubled and distant, and instead to spend more on themselves and their families, spend more time out with their friends and their loved ones today. So therefore, their spend at the restaurants and bars has actually gone up pre-COVID, which is very encouraging for an industry that's been down on its knees. The second trend that surprised us was that for 2 years, people were locked up at home pretty much. They didn't get to travel overseas, which is when they get exposed, they see new things, they want more. And yet, though they were largely homebound for these 2 years, whenever the lockdown would ease and people would be back going out, their appetite had increased, their curiosity had increased. What they were looking for was better, more international. And so that's very encouraging for us restaurateurs because we can create new experiences, better experiences, which is what takes the industry forward. These were the 2 of the strong trends that we saw in this year.
Right. Thanks a lot for joining in, AD and Gauri. Gauri, let me come to you. Yes, it is great to see that all the tables, etc., are full on the New Year's Eve. There is a lot of revenue expectations, etc. But, that one event aside, how do you think, all of December has inflation slowly started to hurt people and them eating out?
I think, of course, it has. It's not just December. It's been there the entire year. It's definitely had an impact on our industry. But I think, like AD said, people are, in a mood for celebration. They're in a mood to live life. And, travel is back. As much as people are traveling abroad, they're also coming back to India. Last year we had Omicron at this time. So this year, I think people are just out to enjoy and make the most of life. And of course, inflation's hurting everybody, but we are seeing people coming out.
Guys, I'm really disappointed. You know, when you guys started the conversation, I thought you were going to ask them about what is the best new cocktail, mocktail, best new drink, what is the best cuisine. I mean, you know, this is end of the last trading session, and how's
that
business
will only
and
make us feel
footfalls
bad, because they'll tell you that, you know, this is the best new cocktail, this is the best new drink, and then they'll only tell us that we have no tables for you, and you guys can't obviously have those cocktails. And
you do know that Mangalam and me are teetotalers, right?
Yeah.
We don't drink. So I think that's a question best placed for you to ask them.
Okay, go for it, Prashant.
Mr. Singh, so I don't know, I mean, if you want to take that up, but how is 2023 looking? I mean, as you look ahead, are you looking at it with a lot of optimism, or you think we are at a, you know, it was a very unusual last two and a half years, right? Because of COVID and what is done to people, the need to get out and the need to splurge, spend. There was a neat term coined for it, revenge spending, revenge travel, or whatever. Have you seen the peak of that, or do you see that continuing? I mean, this trend continuing?
So, Prashant, as you know, with this COVID and what's happened, nobody had any idea what was going on. We're, of course, hopeful, because it was such a bad 2 years, that people will continue to come out in large numbers. People will spend more today than they used to on themselves in the past. If you look around Asia, leave the world, the habits of people in terms of going out and having meals out is much more than in India. And we are seeing the trends growing, and we hope that that'll continue. However, as you all know even better than me, there are a couple of strong worry factors. One is COVID coming back? Have we built up enough herd immunity and vaccinations to be able to handle it like we did Omicron, or would it be worse than that? So that's a big worry for 23. And the other is sort of the war talk around the world. The Russian war is not getting over. There seems to be a lot of posturing by other countries as well. And, you know, obviously all of that impacts the economy and impacts us in the end. So there's a lot of positivity, and there's a bit of worry coming into 23.
And that, because I remember you had, spoken about this way back in 2021 as well, Mr. Singh, where you said that because of the after effects of COVID, 50% of the restaurant industry may find it difficult to reopen. A lot of businesses would shut down as well. And you've seen many of your own businesses struggling to sort of resurface because of COVID. But how is the industry managing now? What about profitability? Is it back, not just for yourself, but for the industry as a whole?
So yes, as an industry, we were very worried how many would survive. Right now, our best guess is that about 15 to 20% of restaurants, unfortunately, had to close. That's horrible for any industry. But for those who survived, like the Olive Group did, it's resulted in extra business and helped us to get over the losses and the debts that had piled up during the lockdowns. In terms of profitability, what happened was that many of the staff at all our restaurants and bars went home, had a very difficult time, didn't get any support. As a result, either migrated and left the industry entirely, or stayed back at home, worked in the farms with their families, started some small businesses. So this year has been very difficult to get the teams that all of us need to do the service that we need to, prepare the food that we need to. But on the other hand, because of that, our HR costs have been very tight. And so profitability has actually been very good post both the lockdowns for those that have survived.
Edie, thank you for brightening our mornings up with that wonderful fedora that you're sporting right now. Rarely do we see people, dressed like that on a business channel. but it's the last day of the year. Gauri, let's now cut to the chase. Now we know that a lot of people are eating out. Inflation is a worry, etc. Restaurants have shut, but now they'll manage on, and all of that is a conversation we'll have maybe pre-budget and all of that. For the 31st, what is it that you guys are doing special? I mean, what can we expect?
Just lots of amazing food, great wine, great cocktails, and just lots of, I think, revelry. As people are, in the mood to just enjoy, like Katie said, and you'll see lots of restaurants, bars, all full to the brim, not just Bombay, all across the country. I'm pretty sure of that.
So what are the top 2 places to be in Mumbai tomorrow evening?
Olive and the table.
Okay, I'm going to be at one of them for sure. Olive or the table, right?
We need to know whether they have the tables. You guys are running full tomorrow, or will you all manage to eke out?
Anything for you guys, yeah? I mean, come on.
There's always a table for you.
Show up.
Oh, thank you. But have you made it a lot more expensive this time around as well? I mean, because you're talking about the best food, the best wines, the best whatnots, but all of that comes at a serious price, and they're already hiked on the 31st. How much higher are they this year as compared to last year?
That's for me to know and you to find out when you come to dine. No, I think,
Okay.
of course, like you talked about inflation, it is something that we all have to factor in, but hopefully everyone will leave happy at the end of the meal.
Absolutely, and this has been a good year because we've come out of such a bad year, right? So Happy New Year to both of you, and hope we get a table at the table. Gauri, thanks for joining us. Mr. Singh, thanks to you as well. We will move on now to the big story this morning, the other big story this morning, which is India's current account deficit touched a 9-year high of 4.4% of GDP in the July-August-September quarter. This was mainly due to a sharp rise in the merchandise trade deficit in those months. Lata's here to give us more on that. Lata, over to you.
It's a tough unfair to ask me these jargonized questions after that very interesting chat on what's going to happen on New Year's Eve. But yeah, the dollar is more expensive. I mean, likely to be more expensive because of the numbers I'm going to tell you. The current account deficit has touched 4.4% of GDP. That's the difference between our imports and our exports, broadly, including services and other flows. At 4.4% of GDP, it's a tad dangerous because India's for the last 30 years worked with a Lakshman Rekha of 2.5% to 3%. We don't like it to go above 3%. Now, the problem is this is caused by a 30% rise in imports. Imports have done well, but that is only a 16% rise in, exports. So imports clearly are the problem. And if you thought crude imports is the problem, no. Non-oil imports have risen by 25% in the quarter. And therefore, that clearly is not only an oil issue. The things that have done well for the current account deficit are service exports, software, grown by 30%, and Indians living abroad and transferring money to India, that private transfer is also up 30%. So that's what's working positive. But still, there is this deficit, 36 billion. How do you fill it? That's the FDI, the portfolio flows and the FII flows. Their FDI flows are a good 2 billion lower than what it was last year. FPI flows were good, but external commercial borrowing, loans taken by Indian corporates abroad, was zero. So that, again, was not enough to fill the deficit. So we have a balance of payments deficit, which means we pulled out from the reserves to pay for it. The reserves fall was about $30 billion compared to a surplus, an addition of reserves in the year ago, same quarter. But let me end with some good news. After all, you all began with the New Year's cheer. So the good news is that the previous quarter, April, May, June quarter numbers have been revised lower. The deficit we were told earlier was 2.8%. It's brought down to 2.2%. That's because the calculated imports were not as bad as customs made it out to be last quarter. 191 billion has become 185 billion. So the trade deficit of last quarter, which was 68 billion, has become 63 billion. Nevertheless, if you count Q1 and Q2, it is still a current account deficit of 3.3% of GDP. Like I told you, it's over our Lakshman Rekha. However, the positive is economists think that H2 current account deficit could be a tad lower.
Okay, forget all that. Where are you partying tomorrow night, Lata?
That'll remain a secret.
We're still waiting for your birthday party, by the way.
Yeah.
Hope you had a great one. Thanks a lot
Thank you.
for
Thank you for
joining in. Well, Vahishta is with us to tell us about the momentumizer stock of the day. Vahishta, over to you.
Hi, Sonia. I'm going to be talking about Skipper Limited today. In fact, the current market price is at approximately 140, which is very close to its 52-week high of 142 rupees. Now, let's look at how the stock has performed in the recent past. Yesterday, the stock had rallied 8%. In the past 1 week, it was up 20%. And in the past 1 month, it was up at 55%. Yesterday, in fact, the volumes on NSE were at 19.8 lakh shares, which is to be compared with its 10-day average volumes at 9 lakh shares. Now, let's brief you a little bit about the company, which is a manufacturer of power transmission and distribution structures and also prominent manufacturer of telecom and railway structures. Now, in start of this month, there was a positive development on the government front, wherein the Government of India had expanded the scope of remission of duties and taxes on the exported products scheme in the engineering products business, which means that the scope now includes the export of articles of iron and steel under Chapter 73 of the ITC schedule, which mainly covers Skipper's engineering export products. Now, this bottom line means that it is expected to boost the export competitiveness for the company. Also, the tender pipeline continues to be very strong at present. The company is actively pursuing export projects, which are worth approximately 5,000 crores and 5,000 crores on the domestic front, which is currently under different phases of bidding or negotiation and could lead to a significant portion of those getting converted into the order book by the upcoming quarters. Remember, we are also hosting the management on our channel today at approximately 11:40. So tune in for more details on that. Back to you.
All right, Vaishta, thanks a lot for that. We will tune in for more details. That's the stock which has some momentum behind it. Anand Tandon is still with us. Anand, do you think that 2023 will be way more bottom-up than all the other years? Because that's what everyone's saying, that it'll be a little more difficult this year to, just paint everything with a broad brush. If that is the case, then what are the specific sectors that you're looking at?
So first of all, I have a different view. I think it will be more macro than micro.
Okay.
For the simple reason that, the major trigger that you are anticipating is the fact that the increase, that the, move out of the US will actually help emerging markets. And the case being made is that among emerging markets, given India's increased weight now, we will continue to have a lot of flows. Do remember that when you have foreign inflows, they are largely top-down. You are going to look at large-cap companies, not small and mid-cap companies. And within the domestic market, I would expect to see, I'd be very surprised if you don't have a slowdown in terms of mutual fund flows into equities, largely, as I argued before, because of a shift towards debt. So as a consequence, if you are largely dependent on the foreign investor trying to make the market at the margin, you are going to have a top-down kind of approach. That said, it doesn't mean you cannot figure out sectors, as I have been talking about, basically domestic sectors which are based on farms. I would argue that some of the beaten down export sectors like pharma, etc., which have not attracted any attention for a while, are also something that one may want to look at. And there is an expectation that, again, things like two-wheelers, etc., which have gone up, which haven't done at all anything in terms of volume or price, are also potentially investable. Infrastructure, which everybody else is rather bullish on, I think I would be a little more careful, largely because of the fact that we will be entering into the last 12 months before the election. And I think the amount of money that the government can spend is towards infrastructure as opposed to towards welfare schemes, is likely to bend a little more towards welfare schemes. Even in the current year, infrastructure, though it has been much talked about, if you actually see the spend, it has been fairly slow, both at the state and central levels.
Okay. What about this whole reopening theme, Anand, which has played out quite well for, a lot of sectors? Going forward, anything that you like, whether it's aviation or hotels, something like, cinemas, PVR, anything on your radar?
In my view, most of those things have been played out. If you are at all looking at reopening, the expectation is reopening of China. And from that perspective, there is some activity towards most commodities. I would argue again that, other than perhaps aluminum, most of the other commodities are not likely to see a great uptick because of China. If at all you want to be, for example, in metals, I would still prefer something like silver rather than, let's say, a steel.
Anand, stay on. We'll just take a short break, come back, continue our conversation. And as we take that short break, let's also tell you what's lined up on the show for the next half an hour. We bring you the top stock picks for the day from our technical and F&O experts. And then at around 9 a.m., Anuj Singhal will join in for a quick trade setup Following in, Prashant will obviously bring you the Market Laser, a segment where we analyze stocks and sectors through a technical lens. At 9:10, Nimesh will be there with the standout brokerage report of the day. And before the market opens in CNBC TV18 Stocks Board, we will highlight the top stocks in news to focus on for the day.
Okay, welcome back. 6 minutes to go for the pre-open session. Mitesh Thakkar and Kush Bora are joining in for some technical trading ideas. Gentlemen, good morning. Great to have both of you here. Last session of the year, Mitesh, the markets pulled back, right? And with yesterday's very sharp recovery, has it already almost completely negated this downward move that we saw from the middle of December? Are we out of it now? What's your sense?
So, good morning, Prashant. We've been talking about a pullback rally. I think today's action would be very important because today, yesterday's closing was around 18,190, and I've talked about 18,250 as the trend deciding level in the short term, and we are likely to open around that level with the SGX indicating a 50-60 point kind of a gap up. So my understanding is that if we see follow through and if the gap sustains, then I think we're out of the woods. Otherwise, if we see a decline happening after the gap up opening, then I think we're back to the grind and we might actually be in for a retest of 17,800. So I think in that sense, the last day of the year would be important to determine whether we start the next year on a strong foot or a back foot.
Okay, Kush Bora is also with us. Kush, thanks for being with us through the year gone by. What is the level for today, and what are you looking at as we head into the new year? Do you think this outperformance that the Nifty has seen is something that can continue? Is that what the charts are telling you?
Sure. First up, Sonia, wishing a very happy, healthy, and wealthy 2023 to the entire CNBC TV18 team and all its viewers. I hope we get record inflows of $100 billion this year, and Nifty scales 21, Bank Nifty 50K, and Sensex 75K. To answer your questions, the answer is yes. There is a very high possibility that the outperformance that the Nifty has seen this year will continue for a very simple reason. Here we are fighting for a 6% growth or a 7% growth where the world is deciding between recession or a depression. On a very short-term basis, 18,000 put has an extremely strong base, not only in weekly, but also on the monthly options. This is telling me that there is, support at 18,000. Bulls will be looking out for this level, very, very carefully. If this gets broken, then it's a bit of a concern. But otherwise, we're still in the game. The bulls are still in the game. On the upside, 18,400 and 18,600 is where I'm looking, at for the Nifty. Bank Nifty is for sure on a much stronger footing. PSU Bank Index and Private Bank Index both have been amongst the top 3 gainers for the week. So, a buy on Bank Nifty as well. A stop loss here would be 42,800. The target would be 43,800.
All right, Kush, Mitesh, just hang in there. We'll take a short break, come back. We discuss all your individual stock picks as well. On the other side, we'll also get chatting with Balaji Subramanian.